Before we begin, it is critical to understand that I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The information provided is not intended as financial, legal, or tax advice. The world of home loans and refinancing is highly personal and depends entirely on your individual financial situation, credit history, and the current market. Therefore, you must consult with a qualified and licensed mortgage professional or financial advisor before making any decisions based on the content of this video. This is your guide to understanding the landscape and asking the right questions, not a substitute for professional, personalized advice. Alright, let's talk about the single biggest bill that hits your bank account every month. It's not your car payment, not your credit card, not even your grocery bill. It's your mortgage. For millions of Americans, that number feels like it's carved in stone. You signed the papers, you got the keys, and now you're locked in for the next 30 years. You see that payment leave your account and can't help but wonder, is this really the best deal I could have? With everything in the economy changing, am I leaving money on the table every single month? The answer for a shocking number of homeowners is a resounding yes. The biggest financial opportunity many people are missing isn't some hot stock tip or a complex investment strategy. It's the home loan they already have. They are potentially overpaying by hundreds of dollars a month, thousands a year, and tens of thousands over the life of their loan, all because the process of fixing it seems too confusing, too complicated, or just too much of a hassle. That confusion ends today. This video is your complete guide to demystifying the single most powerful tool available to an American homeowner, refinancing. We are going to cut through all the jargon, all the complexity, and all the noise. By the time you're done watching, you will understand exactly what refinancing is, why it could be a financial game changer for you, and how to determine if it's the right move for your family. We are going to turn that feeling of uncertainty into a feeling of empowerment. So let's start with the absolute basics. What on earth is refinancing? Forget the complicated bank speak. Here's the simplest way to think about it. Refinancing your mortgage is essentially trading in your old home loan for a brand new one. That's it. You're paying off your existing mortgage with a new, and hopefully much better mortgage. Imagine you bought a car 5 years ago and got a car loan with a 7% interest rate. Today, your credit is better and interest rates are lower. You wouldn't keep paying that high 7% rate, would you? Of course not. You'd go get a new loan at 4% to pay off the old one, lowering your monthly payment. Refinancing your home is the exact same principle, but on a much bigger scale with the potential for much bigger savings. The new loan can come from the same lender you're with now, or from a completely different one. The goal is always the same: to get a new loan with terms that are better for your current financial situation. This brings us to the most important question: why? Why would someone go through the process of getting a whole new mortgage? Sounds like a lot of work. Well, the reasons are incredibly powerful, and they usually fall into one of 4 major categories. The number 1, most popular reason people refinance is to secure a lower interest rate. This is the classic slam dunk reason. Your interest rate is the fee the bank charges you for borrowing their money. The lower the rate, the less you pay. It's that simple. Even a small reduction can have a massive impact. Let's run some real-world numbers. Say you have a $400,000 mortgage on a 30-year fixed loan, and your interest rate is 6.5%. Your monthly payment for principal and interest is about $2,528. Now let's imagine that a year or two later, market rates have dropped, and you can now qualify for a new 30-year loan at 5.5%. You refinance. Your new monthly payment is now $2,271. That's a savings of $257 every single month. That doesn't sound like a fortune, right? But let's zoom out. That's $3,084 back in your pocket every single year. That's a family vacation. That's a huge chunk of your kids' college savings. That's a kitchen appliance upgrade. Over the 30-year life of the loan, a 1% drop in your interest rate on a $400,000 mortgage could save you over $93,000 in total interest payments. Now are you listening? It's not just about the monthly savings. It's about the massive long-term wealth you're building by not giving that money to the bank. The second huge reason to refinance is to change your loan term. This is all about how long you'll be paying your mortgage. The standard is 30 years, but you can refinance into a 20-year or even a 15-year loan. Why would you do this? Because you'll pay it off way faster and save an astronomical amount of interest. The trade-off is that your monthly payment will be higher. This is for people whose income has gone up since they first bought their house, and their main goal is to be debt-free as fast as humanly possible. But you can also go the other way. Maybe you started with a 15-year mortgage and life happened. You had kids, changed careers, or just need more cash flow every month. You can refinance your remaining balance back into a 30-year loan. Yes, you'll pay more interest over the long run, but you could slash your monthly payment significantly, freeing up hundreds of dollars to cover other expenses right now when you need it most. It's about adjusting the loan to fit your life, not the other way around. The third reason is a big one, and it's called a cash-out refinance. This is how you tap into the hidden wealth sitting inside your home. Your home's equity is the difference between what your home is worth and what you still owe on your mortgage. It's the part of the house you actually own. So if your home is worth $500,000 and you owe $300,000, you have $200,000 in equity. A cash-out refinance lets you take out a new, larger loan that pays off your old $300,000 mortgage and gives you a lump sum of cash on top of it. So you might get a new loan for $350,000. You use $300,000 to wipe out the old loan, and you get a check for $50,000 in cash. Homeowners use this money for all sorts of smart financial moves. Renovating the kitchen or bathroom, which can increase the home's value. Consolidating high-interest debt from credit cards or personal loans into one lower-interest mortgage payment, or even helping to pay for a child's college education. It's a powerful way to unlock the value you've built in your property and put it to work. Finally, the fourth major reason is to switch your loan type. This is especially crucial for anyone with an adjustable rate mortgage or an ARM. With an ARM, your interest rate is low for an initial period, say 5 years, but after that it can change or adjust based on the market. This means your monthly payment could suddenly skyrocket. Many people refinance out of a risky ARM and into the safety and predictability of a fixed-rate mortgage, where the interest rate and the payment are locked in and will never change for the entire life of the loan. That peace of mind, knowing your payment will be the same next month and 20 years from now, is priceless. So to recap, you can lower your interest rate and monthly payment, change how long you're paying on the loan, pull cash out for other goals, or switch to a more stable type of loan. These are the powerful whys behind refinancing. Now I know what you're thinking. This all sounds great in theory, but what's the catch? There have to be fees, right? Isn't the paperwork a nightmare? How do I know if my credit is good enough? And the biggest question of all, with rates always changing, how do I know when is the perfect time to pull the trigger? Those are the exact questions we need to answer. Because simply understanding what refinancing is isn't enough. You need to know if it's the right move for you, and more importantly, if now is the right time to make that move. Timing is everything. Refinancing at the wrong time, or for the wrong reasons, can end up costing you money instead of saving it. So what are the right reasons? What are the big, game-changing moments in your financial life that should make you pick up the phone and ask about refinancing? Let's break down the 4 most powerful reasons why millions of Americans choose to refinance every single year. And we'll start with the heavyweight champion of them all: securing a lower interest rate. This is the #1 reason, the classic, the one you hear about most often. And for good reason. It's the most straightforward path to saving money. Imagine this. Let's say a family, the Johnsons, bought their dream home 3 years ago. It was a competitive market, and they locked in a $400,000 mortgage at a 6.5% interest rate. Their principal and interest payment every month is about $2,528. They're making it work, but it's a big chunk of their income. Now fast forward to today. The market has shifted. Interest rates have dropped. The Johnsons check online and see that with their good credit, they could potentially qualify for a new 30-year mortgage at 5.5%. 1 percentage point. Doesn't sound like much, does it? But let's run the numbers. If they refinance that same $400,000 balance at 5.5%, their new monthly payment drops to $2,271. That's a savings of $257 every single month. That's over $3,000 a year. That's a family vacation. That's braces for one of the kids. That's a huge boost to their emergency fund. Over the life of the loan, if they stayed for the full 30 years, that 1% drop would save them over $92,000 in interest. Think about that. $92,000 just for making a few phone calls and signing some papers. The general rule of thumb you'll often hear is that refinancing is worth considering if you can lower your interest rate by at least 1%. But honestly, in today's world, even a 0.5% drop can make a significant difference, especially on larger loan balances. It all comes down to how long you plan to stay in the home and what the closing costs are, which, don't worry, we are going to dive deep into that later. The key takeaway here is simple. If rates have dropped since you got your mortgage, you are potentially leaving money on the table every single month you don't look into it. The second huge reason to refinance is for stability. It's about trading uncertainty for peace of mind by switching from an adjustable rate mortgage, or an ARM, to a predictable fixed rate mortgage. Maybe when you first bought your home, you opted for an ARM. They can be very attractive upfront. The lender offers you a super low teaser interest rate for the first 3, 5, or 7 years. It makes your initial monthly payment much lower, which might have been the only way you could afford to get into the house. But here's the catch, and it's a big one. After that initial period ends, the adjustable part kicks in. Your interest rate is no longer fixed. It starts to float with the market, readjusting every year. If market rates have gone up, and they can go up a lot, your monthly payment can suddenly skyrocket. We're talking hundreds, sometimes even over $1,000 more per month. It's a ticking time bomb in your budget. I know people who have lost sleep for months, dreading the day their ARM is set to adjust. This is where refinancing becomes a lifeline. By refinancing, you can take that unpredictable ARM and lock in a stable, fixed-rate mortgage. Yes, the fixed rate might be higher than your initial teaser rate, but you gain something invaluable: predictability. You will know exactly what your principal and interest payment will be this month, next year, and 10 years from now. It will never change. That stability allows you to budget effectively, to plan for the future, and to sleep at night without worrying that a shift in the global economy is going to jeopardize your ability to pay for your home. This move isn't just about saving money. It's about securing your financial foundation. Now for the third reason, and this one is powerful, but it also comes with a serious warning label. I'm talking about the cash-out refinance. Over the years, as you've been paying down your mortgage and as your home's value has hopefully increased, you've built up something called equity. Equity is the portion of your home that you truly own free and clear. It's the difference between what your home is worth and what you still owe on the mortgage. A cash-out refinance allows you to tap into that equity. It's like a secret savings account hidden in the walls of your house. Here's how it works. Let's say your home is now worth $500,000, and you only owe $250,000 on your mortgage. You have $250,000 in equity. With a cash-out refi, you could take out a new larger loan for, say, $300,000. You'd use $250,000 of that to pay off your old mortgage, and the extra $50,000? That comes to you in cash, tax-free. This can be an incredibly smart financial tool when used correctly. People use this cash to do a major home renovation, like a new kitchen or adding a bathroom, which not only improves their quality of life, but can also increase the value of their home even more. It's an investment in your biggest asset. Another brilliant use is for debt consolidation. Imagine you have $30,000 in credit card debt, with an average interest rate of 22%. You are getting crushed by interest payments. You could do a cash-out refinance, pull that money from your home's equity where the interest rate might only be 6%, and pay off all of those credit cards in one fell swoop. You consolidate multiple high-interest payments into a single lower-interest payment. This move alone has saved countless families from financial ruin. But here is that warning I promised. It is incredibly tempting to see that equity is free money. To cash out for a luxury car, a lavish vacation, or just a lifestyle upgrade. Please, I urge you, be careful. You are borrowing against your home. Your house is the collateral. If you can't make the new, higher mortgage payments, you could lose it. A cash-out refi should be for strategic investments or to solve a serious financial problem, not to fund a temporary desire. Finally, the fourth major reason to refinance is a wealth-building strategy that most people overlook: shortening your loan term. The 30-year mortgage is the American standard. But what if you could pay off your house in 15 years instead? Refinancing from a 30-year to a 15-year loan is a power move for people whose income has increased since they first bought their home, and who are serious about financial freedom. Now be prepared. Your monthly payment will almost certainly go up. This sounds crazy, right? Why would you refinance to pay more each month? Because you're paying it off in half the time. And here's the magic. The interest rate on a 15-year loan is almost always lower than on a 30-year loan. So not only are you paying for a shorter period, you're paying at a lower rate. The result? The amount of money you save in interest is absolutely staggering. On that same $400,000 loan we talked about earlier, switching from a 30-year to a 15-year term could save you well over $200,000 in interest payments over the life of the loan. You build equity at lightning speed and you own your home free and clear decades sooner. Imagine being in your 50s with no house payment, heading into retirement with your single biggest expense completely eliminated. That's the goal. Refinancing to a shorter term is like putting your mortgage on hyperdrive and fast-forwarding to financial independence. So lower payments, more stability, access to cash, and paying off your home in record time. These all sound amazing, right? Sounds like a financial cheat code. But there's no such thing as a free lunch. Refinancing isn't free. In fact, it comes with a whole set of fees and costs that can sometimes wipe out all your potential savings if you're not careful. These are the closing costs, and understanding them is the difference between a financial masterstroke and a costly mistake. In the next part, we're going to pull back the curtain on every single one of these costs, what they are, what they mean, and how to make sure they don't eat you alive. Alright, let's dive into the belly of the beast. The term you're going to hear over and over again is closing costs. Think of it as a catch-all phrase, a giant umbrella for a whole bunch of individual line items that can feel like a death by 1,000 paper cuts. But they're not random. Each one has a purpose, and understanding that purpose is your first line of defense. These costs typically range from 2 to 5% of your total loan amount. So on a $300,000 refinance, you could be looking at anywhere from $6,000 to $15,000. That's a huge range, and the difference is knowledge. Let's start with the heavyweight champion of closing costs, the origination fee. This is the lender's paycheck. It's the fee they charge for the service of creating, processing, and funding your new loan. This fee is almost always expressed as a percentage of the loan amount, typically between 0.5% and 1%. So on that $300,000 loan, a 1% origination fee is $3,000 right off the top. Now this is where it gets tricky, because the origination fee has a cousin called discount points, and they look almost identical on paper. A point is just a fancy word for 1% of the loan amount. So 1 point on a $300,000 loan is $3,000. But here's the crucial difference. An origination fee is the lender's mandatory charge for doing the work. Discount points are optional. You are paying extra money up front to buy a lower interest rate for the life of the loan. It's a trade-off. You pay more now to pay less every single month later. Is it worth it? That depends entirely on how long you plan to stay in the home. If you pay $3,000 for points to save $100 a month, you'd need to stay in that home for 30 months or 2.5 years just to break even. Anything less and you've lost money. Anything more, and you're saving money every single month. This is one of the most important calculations you will make. Never, ever confuse a mandatory origination fee with optional discount points. Next up, the appraisal fee. This one feels personal. The lender needs to know what your house is currently worth to make sure they aren't lending you more money than the property can secure. So they hire an independent third-party appraiser to come out, walk through your home, measure it, take pictures, compare it to recent sales in your neighborhood, and put an official value on it. You pay for this service, typically somewhere between $400 and $800, depending on your location and the complexity of your property. Can you negotiate this? Almost never. The lender needs that independent valuation to protect their investment. What you can do is ask if an appraisal waiver is possible. In some cases, if you have a ton of equity and a high credit score, the lender's automated system might decide a full appraisal isn't necessary. It's a long shot, but it never hurts to ask. Now for the one that confuses almost everyone, title insurance and a title search. You might be thinking, wait a minute, I already bought title insurance when I bought the house. Why do I need it again? It's a fair question, but you're not buying it for yourself this time. You're buying it for your new lender. A title search is when a company scours public records to make sure there are no outstanding claims, liens, or ownership disputes on your property. They're checking for things like unpaid contractor bills, back taxes from a previous owner, or a long-lost heir who might suddenly claim the house is theirs. Once the search comes back clean, they issue a new lender's title insurance policy. This policy protects the lender, not you, ensuring that if some crazy ownership issue pops up down the road, their investment, the money they lent you, is safe. This is non-negotiable. The lender will not give you a dime without it. The costs can vary wildly by state, from a few hundred to a couple $1,000s, but it's a mandatory cost of entry. Okay, let's move from the big, chunky fees to the section that causes the most headaches: prepaids and escrow. This is the part that feels like you're just handing over a giant pile of your own money for no reason. But it's not a fee. It's your money being set aside for your future bills. Lenders require you to pay for certain things in advance, or prepay them at closing. The two big ones are your homeowner's insurance and your property taxes. First, you'll likely have to pay for a full year of your homeowner's insurance premium up front. Second, and this is the big one, you have to establish a new escrow account. Your old escrow account with your old lender gets closed out, and you'll eventually get a refund check for whatever was in it. But your new lender needs you to fund a new escrow account with them from day one. They do this to build up a cushion. They'll calculate how much your annual property taxes and insurance are, divide by 12, and that's what you pay each month. But what if your big property tax bill is due just 2 months after you refinance? You wouldn't have paid enough into the account yet to cover it. So at closing, they collect several months' worth of these payments up front to make sure there's always enough in the account to pay those bills on time. It can feel like a huge hit, often thousands of dollars, but remember, this isn't a fee the lender is pocketing. It's your money, sitting in a special savings account waiting to pay your bills. Finally, we enter the jungle of what are sometimes called junk fees. This is where you have the most power to negotiate. These are all the little administrative and processing fees the lender tacks on. You'll see things like an underwriting fee, a processing fee, an application fee, a document preparation fee, or a courier fee. Individually, they might only be $50 or $100, but together they can add up to over $1,000. Here's the secret. Many of these are just different names for the same thing, the lender's cost of doing business. An underwriting fee and a processing fee are both paying for someone at the bank to look at your file. You shouldn't have to pay for both. This is where comparison shopping is your superpower. When you get a loan estimate, the official legally mandated document that breaks down every single cost from different lenders, you can put them side by side. You can go back to lender A and say, look, lender B isn't charging a document prep fee. Can you waive that? Many times, to win your business, they will. They have wiggle room on these internal administrative fees that they simply don't have on third-party costs like the appraisal or title insurance. Don't be afraid to question every single line item in this section. Ask what it's for. Ask if it can be waived or reduced. This is where you can save yourself hundreds, if not thousands of dollars. So, to recap the battle plan, you have the big, mostly non-negotiable costs like origination, appraisal, and title. You have the escrow and prepaids, which is your own money being set aside. And you have the smaller administrative fees, which are your prime targets for negotiation. The key to it all is that standardized form, the loan estimate. It is your map through this entire process, showing you exactly what the lender expects you to pay. Now that you understand the true cost of refinancing, the price of admission to this financial tool, the next logical question is, what exactly are you buying? What are the powerful, different types of refinance loans that can lower your payment, get you cash, or completely change your financial future? Because understanding the cost is only half the battle. Knowing which weapon to choose for your specific situation is where the real power lies. So you're standing in the financial armory, looking at a wall of refinance loans that can lower your payment, get you cash, or completely change your financial future. Because understanding the cost is only half the battle. Knowing which weapon to choose for your specific situation is where the real power lies. Let's start with the most common, the most straightforward tool in the entire arsenal, the rate and term refinance. Think of this as the sharpshooter's rifle. It has one primary target, one clear mission: to get you a better deal on your existing loan. You're not pulling out cash, you're not making a dramatic change. You are simply swapping your old, clunky mortgage for a new, sleeker one with a lower interest rate, a different loan term, or both. That's it. It's the purest form of refinancing. The number one reason people use this tool is to lock in a lower interest rate. If you bought your home when rates were at a peak, and now they've dropped by even a single percentage point, you could be leaving thousands of dollars on the table every single year. Let's make this real. Imagine a couple, we'll call them the Bakers. They bought their dream home for $450,000 and took out a $400,000 mortgage at a 6.8% interest rate. Their monthly principal and interest payment is about $2,594. They're making it work, but it's tight. 2 years later, their credit scores have improved, and the market rates have fallen. They see that they can qualify for a new 30-year loan at 5.5%. Their remaining loan balance is now around $392,000. They decide to pull the trigger on a rate and term refinance. Their new monthly principal and interest payment? It drops to $2,226. That's a savings of $368 every single month. That doesn't sound like a lottery win, does it? But let's zoom out. Over the course of a year, the Bakers have an extra $4,416 in their pocket. That's a family vacation. That's a fully funded Roth IRA for one of them. That's a massive chunk of their highest interest credit card paid off. Over 5 years, it's over $22,000. All for making a single strategic financial move. They didn't have to move, they didn't have to get a second job. They just optimized the biggest debt they had. But remember the name, rate and term. The term part is the other powerful lever you can pull. This is for people who are in a stronger financial position and want to shift from defense to offense. Let's say the bakers are doing great. They got promotions at work. Instead of just lowering their payment, they want to attack their debt and build wealth faster. They could refinance their $392,000 balance not into a new 30-year loan, but into a 15-year loan. Now hold on, because the math gets interesting here. A 15-year mortgage almost always comes with an even lower interest rate than a 30-year. Let's say they get 4.9%. Their new monthly payment would actually increase significantly, jumping to around $3,115. That's over $500 more than their original payment. So why on earth would anyone do this? Because they're playing the long game. By paying their home off in 15 years instead of 30, they will save an astronomical amount of money in interest. We're talking a difference of over $200,000 in interest payments over the life of the loan. They are sacrificing short-term cash flow for long-term, life-changing financial freedom. They will own their home free and clear, decades sooner than their neighbors. That's the power of changing the term. So the rate and term refi is the precision tool. It's for optimizing. But what if you need more than just optimization? What if you need capital? What if you need a bigger, more versatile tool? That brings us to the second weapon in our arsenal, the cash-out refinance. If the rate and term is a sharpshooter's rifle, the cash-out refi is the Swiss Army knife. It's powerful, it has multiple uses, but you have to know what you're doing, or you can cut yourself. A cash-out refinance is when you take out a new mortgage for more than what you currently owe, and you get the difference back as a tax-free check at closing. You are tapping into the equity you've built in your home, the difference between what your home is worth and what you owe on it, and turning that paper wealth into cold, hard cash. Here's how it works. Let's go back to the bakers. Their home is now appraised at $550,000. They owe $392,000. Most lenders will allow you to borrow up to 80% of your home's value in a cash-out refinance. So, we take the appraised value, $550,000, and multiply it by 80%. That gives us $440,000. This is the maximum new loan amount they can get. So, the new loan of $440,000 pays off the old loan of $392,000, and what's left over? $48,000. After closing costs, let's say they walk away with a check for about $42,000. Now comes the million-dollar question. What do you do with that money? This is where the Swiss Army knife analogy comes in. The most common and often wisest use is for home improvements. You're using your home's value to invest back into the home. That $42,000 could be a brand new kitchen, a finished basement, or a new master bathroom. Not only does this improve your quality of life, but it can also increase the value of your home, essentially paying for itself over the long run. But there's another, incredibly powerful use: debt consolidation. This is a game changer for so many Americans. Imagine the bakers not only have their mortgage, but they've also racked up $25,000 in credit card debt at a crippling 24% interest rate, and they have a $15,000 car loan at 8%. Between those two debts, they're paying nearly $1,000 a month, with a huge chunk of that just evaporating into thin air as interest. With their $42,000 in cash, they can wipe both of those debts out completely, instantly. Their $1,000 a month in high-interest payments vanishes. Yes, their new mortgage payment will be higher than a simple rate and term refi, but it will be nowhere near the $1,000 they just freed up. They've traded high-interest, inefficient debt for low-interest, tax-deductible mortgage debt, dramatically improving their monthly cash flow. Other people use this cash to start a business, to pay for college tuition, or to put a down payment on an investment property. It can be a powerful catalyst for building wealth. But, and this is a huge but, you have to respect the tool. This is not free money. You are increasing the total amount of debt on your home. You are turning unsecured debt, like a credit card, into secured debt. That means if you get into financial trouble and can't make your payments, the bank can foreclose on your home. That credit card company couldn't do that. You are also spreading the repayment of that old debt over a new 30-year term. So while you save a ton of money month to month, you could end up paying more in total interest on that $40,000 over the next 3 decades. It is a strategic trade-off. Immediate and powerful cash flow relief in exchange for a larger long-term debt. Choosing between a rate and term and a cash-out refinance comes down to one simple question. What is your primary goal? Is it to optimize your existing debt and pay less over time? That's the rate and term rifle. Or is it to unlock your home's equity to solve another financial problem or seize an opportunity? That's the cash-out Swiss Army knife. These two are the workhorses of the refinancing world, but they are far from the only options available. What if you're a veteran? What if you have an FHA loan? What if you want to get rid of PMI but don't need cash out? There are specialized tools designed for very specific missions, streamlined refinances that require less paperwork, government-backed programs with incredible benefits, and even ways to bring money to the table to get a better deal. And understanding those is how you go from being a homeowner to being a truly savvy financial operator. And the first tool in that Savvy Operators Toolkit is called the Streamline Refinance. The name itself tells you almost everything you need to know. It's designed to be faster, simpler, and require vastly less paperwork than a standard refinance. Think of it as the express lane at the grocery store. You already have a cart full of groceries, or in this case, a loan with a specific lender or government agency, and you just want to check out with a better price, not go through the entire shopping experience all over again. The most common and powerful Streamline programs are backed by the government, specifically for homeowners who already have a government-backed loan. Let's start with the FHA Streamline. If you currently have a loan insured by the Federal Housing Administration, this is your golden ticket. The primary goal of an FHA Streamline is to lower your interest rate and, therefore, your monthly payment. The government wants you to succeed as a homeowner, so they've created this path of least resistance to help you save money. Here's what makes it so streamlined. In most cases, there's no new appraisal required. The lender can often use the original appraisal value of your home from when you first bought it. This is huge. It saves you the appraisal fee, which can be hundreds of dollars, and it removes the anxiety of hoping your home's value is high enough. It also means that even if your home's value has slightly decreased since you bought it, you can still potentially refinance, which is often impossible with a conventional loan. Furthermore, FHA Streamlines often don't require income or employment verification. The logic is simple. You've already been making your FHA loan payments on time. The new loan will have a lower payment. So, if you could afford the higher payment, it's a safe bet you can afford the new lower one. This is a massive benefit for people who may have become self-employed, changed jobs, or had a change in income since they first got their mortgage. But there's a critical rule you must know. The Net Tangible Benefit Test. This isn't just jargon. It's a consumer protection rule. It means the refinance must provide a real, measurable financial benefit to you. Typically, this means your new combined principal and interest payment, plus the annual mortgage insurance premium, must be at least 5% lower than your current one. The lender can't just churn your loan for a tiny, insignificant rate drop to generate fees. The benefit has to be tangible, it has to be real, and it has to be in your pocket. Now, let's talk to our veterans and active duty service members. If you have a VA loan, you have access to what is arguably the most efficient and beneficial refinance product on the market, the VA Interest Rate Reduction Refinance Loan, or IRRRL. It's often called the VA Streamline. The name says it all. Its sole purpose is to lower your interest rate. Just like the FHA Streamline, an IRRRL typically requires no appraisal and no income verification. It is lightning fast. The VA's philosophy is the same. You've already been approved for a VA loan, you've served our country, and you deserve a simple path to a lower payment. The process is so stripped down that some lenders can close an IRRL in just a couple of weeks. A huge advantage of the IRRRL is how costs are handled. You can often roll all closing costs, including the VA funding fee, into the new loan amount. This means you can refinance to a lower rate with $0 out of pocket. Your loan balance will go up slightly, but your monthly payment will go down significantly, resulting in immediate cash flow improvement and long-term interest savings. And here's a critical piece of information for many veterans. If you are receiving VA disability compensation, you are exempt from the VA funding fee entirely. This can save you thousands of dollars on the refinance, making an already great deal even better. The one major rule for an IRRL is that you cannot take cash out. This is purely for rate and term improvement. The third government Streamline program is for those with a USDA loan. These loans are for properties in eligible rural areas, and if you have one, you can use the USDA Streamlined Assist Refinance. It follows the same principles. a simplified process to help you get a lower payment. It also typically doesn't require a new appraisal, and in many cases, the lender can use your original credit report. The key requirement is that the new loan must lower your monthly payment by at least $50. Again, it's all about that net tangible benefit, ensuring the process genuinely helps the homeowner. So you have these three incredible government-backed express lanes: FHA Streamline VAIRRRL and USDA Streamlined Assist. They cut out the red tape to deliver one primary benefit: a lower monthly payment with minimal hassle. But what if you don't have a government-backed loan? Or what if your goal isn't just to lower your rate, but to fundamentally improve the structure of your loan? This brings us to the second type of savvy financial operation: the cash-in refinance. This is the exact opposite of the cash-out refi you've probably heard about. With a cash-in refinance, you bring your own money to the closing table to pay down a portion of your mortgage balance. Now you might be thinking, wait, why would I give the bank more money? And the answer is to save yourself a fortune in the long run. The number one reason to do a cash-in refinance is to eliminate private mortgage insurance, or PMI. As you know, if you buy a home with a conventional loan and put down less than 20%, the lender requires you to pay PMI. This insurance protects the lender, not you, and it can add hundreds of dollars to your monthly payment without reducing your loan balance one bit. You can get rid of PMI once your loan-to-value ratio, or LTV, hits 80%, meaning you owe 80% or less of the home's current value. Let's paint a picture. Say your home is worth $400,000 and you owe $332,000. Your loan-to-value ratio is 83%. You're stuck paying $200 a month in PMI. You see that interest rates have dropped and you want to refinance, but even with a new loan, you'd still be at 83% LTV and still paying that PMI. But with a cash-in refi, you could bring $12,000 to closing. That money pays your loan balance down directly to $320,000. Suddenly, your LTV is exactly 80%. Not only do you get the new lower interest rate, but that $200 a month PMI payment vanishes. Poof, gone forever. You just spent $12,000 to save $2,400 every single year, plus all the interest savings from the lower rate. That is a powerful financial move. The second reason for a cash-in refinance is to qualify for a better interest rate. Lenders view LTV as a measure of risk. The more equity you have, the less risky you are. Because of this, they offer their best rates to borrowers with lower LTVs. There are often specific tiers, say at 80%, 75%, and 70% LTV. Bringing a few $1,000s to the table to cross one of these thresholds could unlock a significantly lower interest rate for the entire life of your loan, saving you tens of thousands of dollars. You're essentially buying down your risk in the lender's eyes, and they reward you for it. Finally, a cash-in refi can help you qualify for a refinance in the first place, especially in a flat or declining housing market. If your home's value has dropped, your LTV might have risen above the lender's maximum limit, which is often around 95% or 97% for a conventional refinance. If you're stuck and unable to refinance, bringing in cash can reduce your loan balance and push your LTV back into the acceptable range, allowing you to escape a high-interest loan that you'd otherwise be trapped in. So you see, these aren't just different loan products. They are strategic financial instruments. The Streamline Refi is your scalpel, a precise tool for a quick rate reduction with minimal disruption. The Cash-in Refi is your investment, using capital today to eliminate recurring costs and secure better terms for tomorrow. But what if your goal is the opposite? What if you don't want to bring money to the table but take money away from it? What if you need to tap into that hard-earned equity to tackle high-interest debt, fund a major renovation, or pay for college? That's where we enter the world of the cash-out refinance. A tool so powerful it can change your financial life, but one that demands an even greater level of understanding and respect. So let's break down exactly what a cash-out refinance is. Forget the jargon for a second. Think of your home like a savings account. Over the years, as you've paid down your mortgage and as your property value has hopefully increased, the amount of money you truly own in that account, your equity, has grown. A cash-out refinance is simply a way to withdraw some of that money. It's a financial transaction where you replace your current mortgage with a new, larger mortgage. You use the new loan to pay off the old one, and the difference between the two, the cash-out, is given to you as a tax-free lump sum. Let's put some real American numbers to this, because that's when the light bulb really goes on. Imagine your home is currently valued at $500,000. And let's say you have $200,000 left to pay on your original mortgage. This means you have $300,000 in home equity. It's a fantastic number on paper, but it's illiquid. You can't use it to buy groceries or pay a hospital bill. Now a lender comes along and says, "We'll typically lend up to 80% of your home's value." This is what's known as the loan-to-value ratio, or LTV. 80% of your $500,000 home is $400,000. So, you take out a new mortgage for that $400,000. The very first thing that happens is that $200,000 of it is used to completely wipe out your old mortgage. Poof, it's gone. The remaining $200,000? That's wired directly to your bank account. That is the cash out. You've just converted the theoretical value locked inside your walls into actual spendable cash. Now, why on earth would someone do this? This isn't about funding a shopping spree. This is one of the most powerful strategic financial tools a homeowner has, and it's typically used for 3 life-altering reasons. First and most common, annihilating high-interest debt. Let's invent a person, we'll call her Amanda. Amanda is a responsible person with a good job, but life happened. A couple of medical emergencies, a car repair, and helping out family left her with $50,000 in credit card debt, spread across 3 different cards. The average interest rate on that debt is a soul-crushing 22%. Every month, she's paying nearly $1,000 just in interest. $1,000 that vanishes into thin air, barely touching the actual debt. She feels like she's on a hamster wheel, running as fast as she can but going nowhere. But Amanda owns a home. She has equity. So she does a cash-out refinance. She pulls out that $50,000. The interest rate on her new mortgage might be 7%. She takes that lump sum and, in one afternoon, pays off every single one of those credit cards. The 22% interest rate is gone. The multiple confusing payments are gone. It's all consolidated into her single, new mortgage payment. She has just traded toxic, high-interest, unsecured debt for lower-interest secured debt. She's not just saving hundreds of dollars a month. She's reclaimed her financial peace of mind. That is a profoundly powerful move. The second major reason is home improvement. This isn't just about getting a nicer kitchen. This is about investment. You use the value of your asset, your home, to increase the value of that same asset. Let's say you want to finish your basement or add a second bathroom, a project that costs $75,000. You could take out a personal loan at 12% or worse, put it on credit cards. Or you can use a cash-out refinance. You pull $75,000 of your home's equity out, at that same mortgage rate of say 7%. You then use that money to execute a renovation that not only improves your quality of life, but could add $100,000 to your home's resale value. You've effectively made your money work for you in the most literal sense possible. The third reason is funding major life opportunities. This could be paying for a child's college education, avoiding crippling student loan debt. It could be seed money to start a business you've been dreaming of for a decade. Or it could be to cover unexpected, overwhelming medical expenses. These are moments where access to a large sum of capital at a reasonable interest rate can fundamentally change the trajectory of your family's future. But this is where we have to have a very serious talk. The power of this tool is matched only by its risk. This is the respect I was talking about. When you perform a cash-out refinance to pay off credit cards, you are performing a debt alchemy. You are turning unsecured debt into secured debt. If you default on your credit card, they can ruin your credit score, they can harass you with phone calls, they can even sue you. But they cannot come to your house and take it. When that debt becomes part of your mortgage, the rules change. Your home is now the collateral. If you fail to make your mortgage payments, the lender can and will foreclose. You could lose your home. This is the fundamental trade-off, and it's not one to be taken lightly. Beyond that, there are other costs. You're taking on a larger loan, which could mean a higher monthly payment, even if the interest rate is lower than your old one. You're also paying interest on a larger balance for the entire life of the loan. And remember, you're resetting the clock. If you were 10 years into a 30-year mortgage, you're now back at day one of a new 30-year mortgage. Over the long haul, that means paying significantly more in total interest. And of course, there are closing costs, just like with any refinance, which are typically 2 to 5% of the new, larger loan amount. That $400,000 loan we talked about could have $12,000 in closing costs that get rolled into the balance. This is also where you might hear about alternatives, like a home equity loan or a HELOC, a home equity line of credit. What's the difference? It's simple. A cash-out refinance is a replacement. You get one new bigger loan that pays off and replaces your old one. A home equity loan or a HELOC is an addition. They are second mortgages. You keep your original mortgage and you add a second, smaller loan or line of credit on top of it. A home equity loan gives you a lump sum with a fixed interest rate. A HELOC works like a credit card secured by your house. You get a credit limit and can draw money as you need it, and the interest rate is usually variable. So which is right? If you have a great interest rate on your primary mortgage that you don't want to lose, a HELOC or home equity loan might be better. But if you can get a better rate on the whole amount and you prefer the simplicity of a single payment, the cash-out refinance is often the cleaner, more straightforward path, especially for large, one-time expenses like debt consolidation. Ultimately, the cash you pull out of your home is not lottery winnings. It is not free money. It is a loan you are taking against your family's single most important asset. The people who use this tool successfully do so with discipline. They use it to improve their financial standing or to invest in their future. They don't use it to buy a depreciating asset like a fancy car, or to fund an extravagant vacation. That is a one-way ticket to financial disaster, ending up with a bigger mortgage and nothing to show for it but memories. The cash-out refinance is a sharp and powerful tool. Used correctly, it can build a better financial future. Used carelessly, it can cause irreparable damage. The choice and the responsibility is entirely yours. This level of financial control is incredible, but it comes with a cost. And speaking of costs, the single biggest hurdle for most people considering any refinance are those pesky multi-thousand-dollar closing costs. But what if I told you there's a way to refinance without paying thousands of dollars out of pocket? Sounds too good to be true, and in the world of finance, too good to be true almost always has a catch. Next, we're going to pull back the curtain on the so-called no closing cost refinance and reveal what's really going on behind the lender's magic trick. So, how does the lender pull off this disappearing act with closing costs? Well, it's not magic, it's math. And it's crucial you understand how the trick works, because you are the one who ultimately pays for it. Closing costs never actually vanish. They are always paid. The only question is how. With a so-called no closing cost refinance, the lender is essentially giving you two main options to cover them without you writing a check on closing day. The first method is the most straightforward. They roll the closing costs directly into your new loan principal. Let's say you're refinancing a loan with a remaining balance of $300,000, and the closing costs, things like the appraisal, title insurance, and origination fees, add up to $5,000. Instead of giving you a new loan for $300,000, the lender gives you a new loan for $305,000. That extra $5,000 immediately pays off all the closing costs. Voila! From your perspective, you brought no money to the table. Feels free. But it's not. You've just borrowed more money. Now, your new monthly payment will still likely be lower than your old one, especially if you secured a much better interest rate. And that's what most people focus on. But what you've done is agreed to pay interest on those $5,000 in closing costs for the entire life of your new loan. Let's run the numbers on that, because this is where the real cost hides. If your new interest rate is, say, 6% on a 30-year loan, that extra $5,000 you borrowed will cost you an additional $29.98 every single month. Let's just call it $30. $30 a month might not sound like a lot. You might spend more than that on coffee in a week. But this isn't for a week. It's for 30 years. $30 a month times 12 months a year times 30 years, that comes out to $10,800. Let that sink in. To avoid paying $5,000 out of pocket today, you've agreed to pay back more than double that amount over the next 3 decades. You've turned a $5,000 expense into a nearly $11,000 debt. So, is it convenient? Absolutely. Is it free? Not even close. You're paying a premium for the convenience of not having to come up with the cash up front. Now let's look at the second, more subtle method lenders use: offering you a higher interest rate. This is often framed as the lender giving you a credit to cover your costs. It sounds generous, doesn't it? The lender is paying your closing costs for you. But again, let's look behind the curtain. Here's how it works. On any given day, a lender has a range of interest rates they can offer. The lowest possible rate is called the par rate. At this rate, the lender makes a standard profit, and you, the borrower, are responsible for paying all the closing costs. But they can also offer you a rate that's slightly higher than par. Maybe 0.25% higher or 0.5% higher. Why would you take a higher rate? Because in exchange, the lender will give you a rebate, which they call a lender credit. This rebate is a specific amount of cash that is used to offset your closing costs. If the credit is large enough, it can cover every single dollar of your closing costs, making it a true no closing cost refinance. Let's use our $300,000 loan example again. Let's say the best available market rate, the par rate, is 6%. At that rate, you'd have to pay the $5,000 in closing costs yourself. But the lender might say, hey, we can offer you a rate of 6.5%. And if you take that, we'll give you a $5,000 credit to cover all of your closing costs. You do the math. Your new payment at 6.5% is still lower than your old payment on your original high-interest loan, so it feels like a win. And you didn't have to pay a dime out of pocket. Seems perfect. But what's the real cost? At 6%, your monthly principal and interest payment on that $300,000 loan would be $1,798.65. At the higher, no-cost rate of 6.5%, your monthly payment is $1,896.20. That's a difference of $97.55 every month. Let's call it $98. Just like before, that might not seem like a deal breaker. But let's play it out. To avoid paying $5,000 in closing costs, you've agreed to pay an extra $98 every single month. How long does it take for that higher payment to completely erase the benefit? We just divide the closing costs you saved by the extra monthly payment. $5,000 divided by $98. The answer is 51 months. That's your break-even point. It will take you 51 months, or just over 4 years, before the extra interest you're paying costs you more than the $5,000 you saved up front. If you stay in that loan for 5 years, you'll have paid $5,880 in extra interest. If you stay for 10 years, it's almost $12,000 extra. And if you keep that loan for the full 30 years, you will have paid an astonishing $35,118 more in interest, all to avoid a one-time $5,000 fee. So, after hearing all this, you might be thinking that a no-closing cost refinance is a terrible idea, a financial trap to be avoided at all costs. But that's not necessarily true. It's not a scam, it's a tool. And like any tool, it can be incredibly useful in the right situation and damaging in the wrong one. So when does a no-closing cost refinance actually make sense? There are a few key scenarios. The most common one is if you don't plan on staying in your home for very long. Look back at our break-even calculation. In our example, it was 51 months. If you are fairly certain you're going to sell your house and move in, say, 3 years, which is 36 months, then you come out ahead. You will have enjoyed the benefits of the refinance for 3 years, and you'll sell the house long before you hit that break-even point where the higher interest rate starts costing you more than you saved. You'll have paid about $3,500 in extra interest, but you avoided a $5,000 upfront cost. You're $1,500 ahead. In this case, the no-cost option was the smarter financial move. Another scenario is when your primary goal is immediate cash flow, and you simply don't have the savings to cover closing costs. If you're in a financial pinch and lowering your monthly housing payment by a few $100s right now is the most important thing for your family's stability, then a no-cost refinance can be a lifeline. Paying more in the long run might be a trade-off you're willing to make for financial breathing room today. It's a conscious choice to prioritize short-term relief over long-term optimization. Finally, a no-closing cost refinance can be a strategic move in a market where interest rates are falling rapidly. You might grab a no-cost refi today to lock in some savings, knowing full well that you might refinance again in another 12 or 18 months if rates drop even further. Since you didn't invest any cash into the first refinance, there's no feeling of losing your closing cost investment if a better opportunity comes along quickly. It gives you flexibility. The ultimate takeaway is this: there is no such thing as a free lunch, and there is no such thing as a truly no-cost refinance. It's a marketing term for a specific type of loan structure. The costs are real. They're just paid for over time through a higher loan balance or a higher interest rate, instead of with cash from your bank account. The key is to not be swayed by the marketing, but to run the numbers for your own situation. Ask your lender to show you the options side by side. One with standard closing costs and the lowest possible rate, and one with no closing costs and the slightly higher rate. Look at the difference in the monthly payment. Calculate your personal break-even point. Be honest with yourself about how long you realistically plan to stay in the home. Only then can you make an informed decision about whether paying a premium for the convenience of a no-cost refinance is the right choice for you. So now that you understand the true cost of free, and you've weighed the pros and cons, you might be thinking, okay, I'm ready. What's the actual process look like step by step? Getting from I want to refi to having that new loan in place is a journey with some very specific milestones. And in the next part, we're going to give you the complete roadmap from application to closing day, so you know exactly what to expect and how to navigate it like a pro. So let's pull back the curtain on that roadmap. Think of the refinance process not as a single event, but as a series of well-defined stages. Each one unlocks the next, and knowing what they are ahead of time is the difference between a stressful, chaotic experience and a smooth, confident journey. Stage 1, the application. This is where you formally raise your hand and say, "I'm ready." But it's more than just filling out a form with your name and address. This is the financial deep dive. Your lender is going to want to see the complete picture of your financial health, and the faster and more organized you are here, the better your entire experience will be. Get ready to gather your documents. Typically, this means your last 30 days of pay stubs, your W-2s from the last 2 years, and your federal tax returns for those same 2 years, especially if you're self-employed or have variable income. They'll also want to see your last 2 months of bank statements for all accounts, checking, savings, you name it. And of course, they'll need your most recent mortgage statement and a copy of your homeowner's insurance declaration page. The single best piece of advice I can give you for this stage is to create a digital folder on your computer before you even apply. Scan or download every one of these documents and have them ready to go. When the loan officer asks for them, you can email a clean, organized package in minutes, not days. This immediately signals to them that you're a serious, organized borrower, and it sets a positive tone for the entire process. Once your application and initial documents are submitted, you'll quickly move to stage 2, receiving the loan estimate. This is a critical document. Within 3 business days of applying, your lender is legally required to send you a standardized, 3-page form called the loan estimate, or LE. This is your first real look at the numbers. It breaks down the estimated interest rate, the monthly payment, and the total closing costs. This document was designed by the government to be easy to read and to allow you to compare offers from different lenders apples to apples. Pay close attention to page 2, which details the closing costs. You'll see origination charges, fees for services like the appraisal and credit report, and title insurance fees. Some of these fees are set by the lender, while others you can shop around for. The loan estimate isn't a final guarantee, but it's the lender's best faith estimate of what your loan will look like. If you like what you see, you'll give the lender your intent to proceed. This is simply you telling them, "Yes, based on this estimate, I want to move forward." It's not the final commitment, but it's the green light they need to start spending money on your file, like ordering the appraisal. This brings us to stage 3, the part of the process that often feels like a black box. Underwriting. Think of the underwriter as the financial detective for the bank. They don't know you, and their job is to verify every single piece of information on your application to make sure you represent an acceptable level of risk. They will pull your credit report, scrutinize your income documents, analyze your bank statements for any unusual deposits, and review your overall debt-to-income ratio. The underwriter is the final decision maker. During this process, it is extremely common to get a conditional approval. Don't panic when you see this. It's actually great news. It means the underwriter has reviewed your file and is ready to approve it, on the condition that you provide a few more items. They might need a letter of explanation for a recent job change, or proof of where a large non-payroll deposit came from. The key here is speed and cooperation. Respond to their requests as quickly and thoroughly as possible. A delay of a day in getting them a document can delay your entire closing by a day or more. This isn't personal. They are just checking boxes required by law and by the lender's guidelines. Once they have everything they need, your file moves to the next major milestone. Stage 4. The home appraisal. This is often the most nerve-wracking part for homeowners. The lender needs to confirm that the home, their collateral, is worth enough to justify the new loan amount. So they hire an independent, third-party licensed appraiser to determine your home's fair market value. The appraiser will schedule a visit to your property. They'll walk through the interior and exterior, take measurements, note the condition of the home, and document any upgrades or special features. Then they'll do the real work back at their office, researching recent sales of comparable homes in your neighborhood, often called comps. They'll adjust the value based on differences between your home and the comps, things like square footage, number of bathrooms, or a finished basement. The result is a detailed appraisal report with a final value. If the appraisal comes in at or above the value you need for the loan, fantastic. You've cleared a major hurdle. But what if it comes in low? This can be a deal killer, but you have options. You can review the report for errors and formally challenge it, providing your own comps if you have them. You could also try to renegotiate the loan amount with the lender, Or if you have the funds, you could bring cash to the closing to make up the difference. A low appraisal is a roadblock, but it doesn't always have to be the end of the road. Once the appraisal is in and the underwriter has signed off on everything, you hit stage 5, final approval and the closing disclosure. You'll get the 3 most beautiful words in the mortgage world: clear to close. This means the lender is fully committed and ready to fund your loan. At this point, by law, they must send you another critical document called the closing disclosure, or CD. The CD looks very similar to the loan estimate, but these are the final confirmed numbers. It will list the exact loan amount, interest rate, monthly payment, and every single fee you will be charged. Federal law mandates a 3 business day waiting period after you receive the CD before you can actually sign your final loan documents. This is a crucial consumer protection. It's a cooling off period designed to give you time to review everything without pressure. Use this time wisely. Compare the closing disclosure to your original loan estimate line by line. Most of the numbers should be very close. If anything looks different or you don't understand a charge, now is the time to ask your loan officer. Don't wait until you're sitting at the closing table. This leads us to stage 6, closing day. This is the finish line. You'll meet at a title company, an attorney's office, or sometimes even in your own home with a mobile notary. You'll need to bring your government-issued photo ID and a cashier's check or proof of a wire transfer for your closing costs if you're not rolling them into the loan. You'll be presented with a stack of documents. It can feel intimidating, but there are 2 you should pay special attention to. The first is the promissory note. This is your IOU to the lender, your official promise to repay the loan under the specified terms. The second is the mortgage or deed of trust. This is the legal document that secures the loan with your property, giving the lender the right to foreclose if you fail to pay. You'll sign an initial and then sign some more. Once the last page is signed, congratulations. You've officially closed on your new mortgage. But wait, there's one final, secret stage that only applies to refinancing a primary residence. Stage 7, the right of rescission. This is your ultimate safety net. After you sign everything on closing day, the loan doesn't actually fund immediately. A 3 business day clock starts ticking. During this period, you have the legal right to cancel the entire transaction for any reason whatsoever, with no penalty. Maybe you had a change of heart, or you found a mistake you're not comfortable with. You can rescind the deal, and it's like it never happened. If you don't cancel, then on the 4th business day, the rescission period expires, your new lender sends the funds to pay off your old mortgage, and your new loan is officially active. From gathering your W-2s to that final 3-day waiting period, that is the complete journey of a home refinance. It's a structured, predictable process, and now you know every single step. But knowing the path is one thing. Avoiding the hidden traps and costly mistakes along the way is another. And that's exactly what we're going to cover next. The critical blunders that can derail your refinance and cost you thousands, and how to make sure you sidestep every single one of them. The first, and arguably the most seductive trap, is focusing only on the interest rate. It's the big, shiny number lenders dangle in front of you. You see a rate that's a full point lower than your current one and you think, I've won. But the interest rate is only one character in this story. The real protagonist you should be watching is the APR, the annual percentage rate. The APR includes not just the interest rate, but also most of the lender fees and other costs associated with the loan, expressed as a percentage. It gives you a much more holistic apples-to-apples view of what you're actually paying. A lender could offer a temptingly low interest rate, but then bury you in origination fees, points, and other closing costs. Suddenly, that great deal is costing you more over the long run than a loan with a slightly higher rate but much lower fees. It's like buying a plane ticket. You see a $50 flight, but by the time you add the baggage fee, the seat selection fee, and the convenience fee, you're paying more than the $100 ticket that had everything included. Always compare the APRs. This leads directly to the second critical blunder: failing to shop around. This isn't like buying a gallon of milk where the price is pretty much the same everywhere. This is a multi-$100,000 financial product. The difference between lenders can be monumental. A study by Freddie Mac found that getting just one extra quote can save a borrower an average of $1,500 over the life of the loan. Getting 5 quotes? That can save you $3,000 or more. People will spend weeks researching a new TV to save $200, but they'll often take the very first mortgage offer they get. Don't do it. Your loyalty to your current bank means nothing in this transaction. Their first offer is almost never their best offer. You need to get at least 3 to 5 official loan estimates from different lenders, big banks, local credit unions, and online mortgage brokers. Pit them against each other. Let lender B know what lender A is offering. This is one of the few times in life where you have immense leverage as a consumer. Use it. A quarter of a percentage point might not sound like much, but on a $300,000 loan, that's a difference of over $16,000 in interest over 30 years. That's a new car. That's a year of college tuition. You owe it to yourself to make those calls. The third mistake is a silent killer of refinance savings. Completely ignoring your break-even point. This is the single most important calculation you need to make, and it's shockingly simple. Your break-even point is the moment in time when the money you've saved from your lower monthly payment equals the total closing costs you paid to get the loan. The formula is simple. Take your total closing costs and divide them by your monthly savings. Let's say your closing costs are $6,000, and your new loan saves you $200 a month. $6,000 divided by 200 is 30. Your break-even point is 30 months or 2.5 years. You need to live in that house for at least 2.5 years after you refinance just to break even. If you think there's even a small chance you might sell the house or move in the next 3 years, this refinance is a guaranteed financial loss. You'll have paid all those fees for nothing. You need to be brutally honest with yourself about your future plans. How long will you realistically be in this home? If the answer is less than your break-even point, walk away. Next up is a mistake that seems counterintuitive, but can be absolutely devastating to your long-term wealth. Resetting the loan clock. Let's imagine you've been diligently paying your 30-year mortgage for 10 years. You have 20 years left. You see a great rate and decide to refinance into a new 30-year loan. Yes, your monthly payment will almost certainly be lower. Feels like a win, but you just turned a 20-year loan back into a 30-year loan. You've just added a decade of interest payments back onto your financial life. All that equity you built, all those years of paying down principal, you've essentially diluted them. Over the full term, you could end up paying tens, or even hundreds of thousands of dollars more in total interest than if you had just stuck with your original loan. If you're going to refinance, especially if you're well into your current loan, you should strongly consider refinancing into a shorter term. If you have 22 years left, look at a 20-year or even a 15-year refinance. Your monthly payment might be similar to what it was before, or even a little higher, but the interest savings will be astronomical and you'll be debt-free years sooner. Don't just look at the monthly payment. Look at the total interest paid over the life of the loan. The fifth blunder is underestimating, or misunderstanding, closing costs. People hear no-cost refinance and think it's free. Let me be crystal clear. There is no such thing as a free refinance. Lenders are not charities. Those costs, the appraisal, title search, origination fees, and so on, they have to be paid. In a no-cost refinance, the lender is simply paying them for you in one of two ways. Either they're giving you a higher interest rate to cover the costs over time, or they're rolling the costs directly into your loan principal. That means if you owe $300,000 and have $6,000 in closing costs, your new loan balance is now $306,000. You are now paying interest on your closing costs for the next 15 or 30 years. Sometimes this can still make mathematical sense, especially if you're short on cash. But you must go into it with your eyes wide open, understanding that you are financing those fees. Always ask for a detailed breakdown of every single fee on your loan estimate. Question everything. If a fee seems high, ask why. Some fees are negotiable, some are not. But knowledge is power. Which brings us to a mistake that can sabotage your refinance before it even begins. Messing with your credit. From the moment you decide to refinance until the day you sign the final papers, your financial life needs to be in lockdown. Your lender is going to pull your credit at the beginning of the process to pre-approve you, but they are also very likely to do what's called a soft pull, right before closing to make sure nothing has changed. If you go out and finance a new car, co-sign a student loan for your kid, or open 3 new store credit cards to get 15% off, your credit score could drop and your debt-to-income ratio could skyrocket. The lender could see this new activity and pull the plug on your loan at the 11th hour. Or they might reprice your loan at a much higher interest rate, wiping out the very benefit you were trying to achieve. Put a freeze on all new credit. Pay your bills on time every time. Don't make any large, unusual deposits or withdrawals from your bank accounts without a clear paper trail. Basically, be as boring and financially stable as possible until the loan is officially closed. Finally, the last major mistake is simply not reading what you sign. I know it's dozens of pages of dense legalese. It's intimidating, but the 2 most important documents you will receive are the loan estimate at the beginning and the closing disclosure at the end. The law requires that the closing disclosure you receive at least 3 days before you sign looks almost identical to the loan estimate you got at the beginning. Your job is to compare them line by line. Has the interest rate changed? Has the loan amount changed? Are there new fees that weren't there before? If you see anything that doesn't match, or that you don't understand, you must speak up immediately. Call your loan officer and ask for an explanation. This is your last chance to catch errors or junk fees. Don't let anyone rush you through the signing process. This is your money, your home, your future. Taking an extra hour to read and understand everything is one of the highest return investments you will ever make. Avoiding these 7 landmines: the rate obsession, failing to shop, ignoring the break-even point, resetting the clock, misunderstanding costs, damaging your credit, and not reading the fine print, is the key to a successful and profitable refinance. Now that you're armed with the knowledge to sidestep these costly traps, you're ready for the final leg of the journey. You know the what, the why, and the what not to do. The only thing left is the how. In our final part, we'll walk you through the entire refinance process step by step, from the initial application to the closing day, giving you a complete playbook to confidently navigate the system and secure the best possible deal. Alright, you've defined your why. You understand the what, now let's master the how. This is your step-by-step roadmap to refinancing your home, turning confusion into a clear, actionable plan. Step 1, the preparation phase. Before you even speak to a single lender, your work begins. Think of this as your financial training montage. First, pull your credit report and check your score. You can get free reports from the major bureaus. Are there any errors? Any surprises? A higher credit score is your single greatest negotiating tool for a lower interest rate. So if your score is a little weak, it might be worth spending a few months improving it before you apply. Next, gather your documents. This is your financial life in a folder. Lenders will want to see everything, so get it ready now to avoid scrambling later. We're talking about your last 2 years of W-2s and federal tax returns, your most recent 30 days of pay stubs, and the last 2 months of bank and investment account statements. Also, find a copy of your current mortgage statement and your homeowner's insurance policy. Having this refi kit ready makes you look organized and serious, and it dramatically speeds up the process. Finally, redefine your goal. Write it down. Is it to lower your monthly payment by a specific dollar amount? To pull out exactly $50,000 for a renovation? To slash your loan term to 15 years? A clear, specific target prevents you from getting distracted by confusing offers later on. Step 2, go shopping. This is the most crucial step for saving money. You wouldn't buy the first car you see, so don't take the first loan you're offered. Your mission is to get at least 3 to 5 official loan estimates from different types of lenders. Contact your current mortgage provider, a few national banks, a local credit union, and an independent mortgage broker. A broker is key because they can shop dozens of wholesale lenders on your behalf. When you get these loan estimates, you're not just looking at the shiny interest rate. That's a rookie mistake. You need to compare them line by line. Look at the APR, the annual percentage rate. The APR includes both the interest rate and most of the closing costs, giving you a more accurate picture of the loan's true cost over time. Then, look at the closing costs themselves, specifically the lender fees in Box A of the loan estimate. This is where you'll see things like origination fees, processing fees, or underwriting fees. This is where lenders have the most wiggle room, and it's where you can negotiate. Ask them, can you waive this fee? Can you reduce that one? Also, pay close attention to discount points. 1 point costs 1% of the loan amount, and typically lowers your interest rate by about 1/4%. Paying for points is essentially prepaying interest. You need to calculate the break-even point to see if it's worth it. If paying $2,000 in points saves you $50 a month, your break-even point is 40 months. If you plan to stay in the home longer than that, it might be a smart move. If not, you're better off with a no-points loan. Step 3, the formal application. Once you've compared your loan estimates and chosen your champion lender, it's time to officially apply. Since you already gathered all your documents in the preparation phase, this part should be relatively painless. You'll fill out the application, upload your documents to the lender's secure portal, and give them permission to formally pull your credit and begin the verification process. This leads to step 4, underwriting. This sounds intimidating, but it's just the lender's verification process. An underwriter is like a financial detective. Their job is to verify that all the information you provided is accurate and that you meet the lender's guidelines for the loan. They'll verify your income with your employer, check your bank statements to confirm you have the funds for closing costs, and review your credit history in detail. During this time, the underwriter might come back with conditions or requests for more information. This is completely normal. They might ask for a letter of explanation for a large, unusual deposit or for a more recent pay stub. The key here is speed. Respond to their requests as quickly and completely as possible to keep your loan moving forward. Step 5. The home appraisal. While the underwriter is verifying you, the lender also needs to verify your house. They do this by ordering a home appraisal. An independent, licensed appraiser will visit your property, assess its condition, and compare it to recently sold homes in your neighborhood to determine its current market value. The lender needs to ensure the home is worth enough to be proper collateral for the new loan. You will typically pay for the appraisal upfront, usually a few $100s. But what if the appraisal comes in low? This is a common fear, but it's not always a deal killer. If the appraised value is less than what you need for the refinance, you have a few options. You can challenge the appraisal if you believe there are legitimate errors. You can bring more cash to the table to make up the difference. Or you can try to renegotiate the loan amount with the lender. It's a negotiation point, not an automatic rejection. Step 6. Approval and locking your rate. Once underwriting is complete and the appraisal is accepted, you'll get the magic words, clear to close. This means you are fully approved. Around this time, if you haven't already, you'll need to make a critical decision. Locking in your interest rate. A rate lock is a guarantee from the lender to hold a specific interest rate for you for a set period, usually 30 to 60 days. Interest rates fluctuate daily, just like the stock market. Locking your rate protects you from a sudden spike. The timing is a bit of a gamble. If you lock and rates go down, you might miss out. If you don't lock and rates go up, you'll be kicking yourself. Most people choose to lock their rate as soon as they are confident their loan will be approved, giving them peace of mind for the final stretch. Step 7. Closing. This is the finish line. At least 3 business days before your scheduled closing date, you will receive a critical document called the Closing Disclosure, or CD. This is your final checkpoint. The closing disclosure itemizes all the final, exact costs of your loan. By law, you must compare it to your initial loan estimate. The numbers should be very similar. If there are any significant changes or new fees you don't understand, you must ask your loan officer to explain them immediately. That 3-day review period is your legal right and your final opportunity to catch any mistakes. The closing itself is the final ceremony where you sign a mountain of paperwork. This can happen at a title company's office with a traveling notary who comes to your home, or in some cases digitally. You'll sign the new promissory note, which is your formal promise to repay the loan, and the new mortgage or deed of trust, which secures the loan with your property. You'll also need to provide a cashier's check or wire transfer for your closing costs. For a primary residence refinance, there's one last safety net: the 3-day right of rescission. After you sign everything, you have 3 business days to cancel the entire transaction for any reason, no questions asked. This gives you one final cooling off period to be absolutely sure. After those 3 days pass, your old loan is paid off, your new loan is officially active, and the funds are dispersed. And just like that, you've done it. You've navigated the maze from initial research to final signature. You've replaced your old, inefficient mortgage with a new one that better serves your financial goals. Your first payment on the new loan will typically be due at the start of the following month, giving you a wonderful 1-month break from mortgage payments. Refinancing isn't a magic button, but it is one of the most powerful tools a homeowner has to take active control of their financial destiny. It allows you to adapt to changing markets and changing life circumstances. Whether you're lowering your payment to free up cash flow, shortening your term to build equity faster, or tapping into that equity to invest in your home or your future, a smart refinance can fundamentally change your financial trajectory. You now have the knowledge. You have the playbook. The only thing left to do is take that first step. Run the numbers, check your credit, and see if a refinance can help you build the financial future you deserve.